Hello CM students, join the live session. We will discuss here study number 1 basic concepts. Hello CM students, join the live session. We will discuss here study number 1 basic concepts. Hello CM students, join the live session. We will discuss here study number 1 basic concepts. Hello friends, welcome to my channel. If you're new here, please like, share, subscribe. So now we will discuss here 1.6 the basic principles principle for charging the income tax, section 4. So section 4 the basic principles of charging the income tax. So what is the basic principles of charging the income tax? Section 4 we will discuss. Income of the previous year of a person is charged to the tax immediately following the assessment year. So immediately following the assessment year, the rate. Section 4 principles for charging income tax deals with the how to charge the income tax. This section how to charge income tax is mentioned in principles mentioned also principles mentioned in this section. Section is 4. Section 4 is the basic principle of a person is charged to immediately following annual finance act in our finance act. So let's discuss briefly here. Every year they have passed bill in the Congress. So now we will discuss basic principles of charging of income tax is section 4. Section 4 of a person, it will be taxable, it will be taxed in the immediately following assessment year. So what is the definitions of persons we will discuss upcoming other topics. We will discuss 1.6 principles for charging income immediately assessment. So the rates applicable as prescribed rates of tax in respect to income, the income tax act, lottery income is to be taxed 30%, is will be under section 115B, and long term capital gain, that is LTGC, 20% under section 1 and 2. So 112 short term capitals on unlisted shares is 111A, that is Nelson A. 111A is to be taxable at the rate of 15%, etc. In respect of the income is chargeable to the tax shall be deducted at source or paid in advance wherever applicable. So wherever applicable. Section 4 of is charging the section, and it is backbone of the Income Tax Act. So section 4 I already discussed how here the section 4 is the backbone of the Income Tax Act for the charging sections. The tax liability arises by the virtue of its section of this section, and it arises at close of the previous year. However, the finalization of amount of the tax liability is to be postponed to the assessment year. It follows the rules that liability to tax not dependent upon the assessment, not dependent on the assessment. So not dependent on the assessment. So rates of some basic principles of charging income tax is section 4. Income tax of the previous year of a person is to be charged to the tax immediately following assessment year. Rates of tax is applicable is specified by the annual finance act of that every year. Of that year. Further, through enhanced act prescribes the rates in respect of certain income. The Income Tax Act itself has prescribed specific rates. For example, lottery income is to be taxed at the rate of 30%. Section 115BB deals with that. So long-term capital gain is to be taxed at the rate of 20%. Section 112 short-term capital gains on listed shares under section 111A is to be taxed at the 50%. In respect of income chargeable tax shall be deducted at source or paid in advance wherever is applicable. So this is the section 4 is the basic backbone of the Income Tax Act. How the taxable liability by the virtue itself, it follows the rules that liability of to tax is not dependent upon the assessment. This is the basic principles to charge the income tax under section 4. This is the basic principles we will discuss here. This is the 1.6 basic principles for charging income tax section 4. Income of the previous year of a person is charged to the income tax in the immediately following assessment year. Rates of the tax is applicable as specified by Annual Finance Act of that year. Through that Finance Act prescribed the rates of tax in respect of certain income of tax itself prescribed by rates. For example, here lottery income, specified incomes, these are the prescribed specific incomes. So that's why examples is given: lottery income, LTGC, long-term capital gains at the rate of 20%. Mentioned in 112 short-term capital gains on listed shares, that is under section 111A is to be taxed at the 15%, etc. In respect of income Chargeable tax shall be deducted and so paid in advance wherever it is applicable. This section 4 is the chargeable section. It will be backbone of the Income Tax Act, whatever may be, by whatever the prescribed rates are given by the assessment year. The finalization of amount of tax liability is postponed to the assessment year. The following rules of liability of tax depend upon the assessment. That is the basic principles of charging section. This charging section 4 is the backbone of the Income Tax Act. It will be prescribed certain specific rates as given in this section. How do rates are will be examples for long-term capital gains, short-term capital gains. These are the specific specific rates given by the Finance Act every assessment year. So every year, previous year, every year in the finance budget. So rates of tax is applicable is specified annual finance act and of that year. So of that year, through finance act prescribe the rates of tax in respect to of certain income. The Income Tax Act itself has prescribed specific rates. For example, lottery income is to be taxed at the rate of 30%, section 115 BB, and long term capital gains is to be taxable under section 20%. Under section 112 and 111 is short-term capital gains on listed shares. Listed shares are to be taxed at the 15%. So this is the chargeable tax in respect of whatever it is. In respect to of chargeable to tax, the tax shall be deducted at source or paid in advance wherever is applicable. So wherever applicable. Section 4 is the charging section and it is backbone of the Income Tax Act. The tax liability arises by the virtue of this section, and it is arised at the close of previous year. However, the finalization of amount tax liability postponed to the assessment year. It follows So it follows rules that rules the liability of to tax is depend upon assessment. So this is the basic principle. I hope you will understand. Okay. Now we will. So assessment year means the period of 12 months commencing on the first day of April every year. Every year it is the year of the after previous year in which income earned in the previous year is to be charged. Assessment year 2021 in the year which commences April and 1st. So April 1 2020 at the ends of 31st 2021. Income of an assessee earned in the previous year of 2020 and assessed to be in 2029. Here assessment year 9. Continue here, assessment year, section 2 of 9. Assessment year, section 2 of 9. So remember this section 2 of 9. Assessment year means the previous year period of 12 months commencing the first day of April every year in the year just after previous year in which income is earned from the previous year is to be charged to tax.